Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you didn't get that email, you need to join my free email list by going in the description below this video, take you to a page, you put in your email address, and then 5 days a week in the morning before they open, you'll get an email from me with the top market headlines of the day and my thoughts of what's going on. We're now in a critical juncture in the markets. And what I'm going to talk about, though, in this video is the number one trade I see right now from a trader's perspective and an investor's perspective. The two are now coming together. It means we've got a great entry point in something that's going to likely be a sustainable move that lasts for a very long time. And that's something that's actually becoming a rarity in these markets. As you probably have been witnessing, we are seeing heightened stock market volatility. We're seeing rallies that last a couple of days, then fade. And also in January, we had a nice decline in the market. It was the biggest January decline actually for the Nasdaq ever, but then we got a bounce. So we need to look at the overall market situation first before we get into the number one trade to make, because they all combine together. The situation, the trends of the market always have to impact the decisions you make. So we have to go through them to understand what's going on and then do a trade that lines up with them. And we are now in a much different market environment than we saw last year in the previous couple of years. Things are changing in the markets. And the thing to do is adapt to those changes. And right now, those changes are having a very negative impact on just about everybody. Because look, most people are not taking what they would consider giant risks in the market. They are not going on margin. They're not loading up on options. They're not day trading. They are, being long-term investors using a strategy where you would say, put half your money in stocks and half your money in bonds, or 40% to 60% in bonds. And that's your safety trade. But what is happening now is that safety trade is not working in this market because we are seeing inflation that has not been seen in over 40 years. And you really got to go back to the 1970s to understand the market environment we're in. The problem is everyone has been conditioned to believe that what happened from 1980 till really last year is the way to always invest. You back test from 1980 to then, and you come up with a system and you think, well, I'm just going to do this because it's always worked. But it has not always worked. It has not worked in times of high inflation, which we are now in. And there's no reason to think that's going to come to an end, as you will see when we look at the chart. But just remember this when it comes to inflation. A year ago, in 2021, in January, we were told by Jerome Powell and various Wall Street analysts and experts that inflation would appear in the spring of 2021 and then go away by the fall. Now, it did not go away. It increased. And then in December, we were told it would be going away, in January and February of 2022. And it has not gone away. In fact, on Thursday, we saw that it went up again. So all the experts have been wrong on inflation, and you can't listen to people's predictions, including mine, about, oh, this is going to happen or that's going to happen. The thing to do is to focus on market trends. That means look at the charts, and the charts were showing us that inflation was not going away. And in fact, the charts, as you'll see in this video, are showing us what we should think is going to happen with the next CPI report that comes out in March. But the Thursday CPI report was a shocker to most market commentators and even to the Federal Reserve itself. I'm going to show you now what I'm looking at. And surprisingly, something that's going to happen on Monday that I can't find really any stories in the media over the weekend about it. And this is the Federal Reserve website, the official website of the Board of Governors of the Federal Reserve System. And on Monday at 11:30, they're holding an emergency meeting because of all the inflation data. They weren't expected to do this, but they are doing it, and they're going to discuss what to do. They say they're going to consider an analysis of the discount rates, and what they should do with them. So it's a possibility that they could. I don't know what they're going to do, but the very fact that they're holding this meeting makes it possible that they are going to raise rates on Monday, or perhaps say, we're just going to cut out the quantitative easing completely instead of paring it down slowly. Or they may do nothing. I don't know. But that's just an item for consideration. And I've been able to find any news stories saying what they're going to do. I will say that after this press release, there were Federal Reserve people saying they don't look to raise rates by 50 points between now and or at the next meeting, and still want to go slow. So take that for what it's worth. But this is going to be a very interesting day on Monday. But Friday, we saw very interesting stock market action in itself because, as I was saying, we saw the steepest drop for the Nasdaq occur in January, then a bounce that now has stalled out, obviously, with the reversal on Thursday and Friday. So the rally is over. And that means that the upside in the short run, and I think, as you'll see, in the long run for the stock market is very limited now. The risks are now to the downside. If I was loaded up in technology stocks or ARK type stocks or things that were under the money and I wanted to lighten up, I would just do it now. I can't predict that it's going to bounce back up or decline, and straight back down to the low. I read, it's very difficult to predict exactly, how things are going to play out, and draw it out exactly in a chart. All I know is the upside is capped. And the rally that we saw stalled out below the 150-day, 200-day, and 50-day moving averages. And much of the stock market is already in a bear market. If we look at the Russell 2000, it is now substantially below those moving averages, and those moving averages are starting to turn down. Not only that, but the Russell is now starting to trade along the lower 200-day Bollinger Band. This is a classic bear market price pattern. Now we have to step back, and you have to understand that I define a bear market as one that's trading below those moving averages, and those moving averages act as resistance. That is the textbook definition of a stage 4 decline. And those declines typically last over a year, and they can last longer. The one in 2007 ended in March of 2009. The 2000 market top ended in 2000. That bear market ended in 2003. So what that means is overvalued stocks that have no earnings are going to get killed and continue to get killed. They've already been killed. Some are down 50% already, and they can go down, again, just as much as they have over the past 6 months. Doesn't mean everything's going to decline. I don't think it is. And there's select sectors, select stocks that will be in bull markets of their own. But we are in a completely different market environment now, and you've got to go into what is bullish now, what has good entry points. And I'll talk about my top trade in a few minutes in this video. We'll get to that. But the stuff most people are still doubling down on or trying to buy bottoms in, it's over. It's over. Facebook is over. Look, Facebook crashed. It made a new low yesterday, and they're trying to say buy it because of metaverse, but then they say metaverse is not going to generate rent review for 10 years. It's no longer a growth stock. It's It's a dream stock with a massive valuation. Netflix crashed too. And these are just two stocks. The ARK ETF is a complete debacle, way below those moving averages, underperforming the market, and so forth. But even more important than these, highly valued areas of the stock market is what is going on in the bond market. This is the LQD ETF. It's a high grade corporate bond ETF. It hit a new 52-week low last week. As you can see from this chart, way below the moving averages. Those moving averages are now starting to turn down, and it's below the 200-day Bollinger Band. This is in a bear market, and it's in a bear market because the value of bond funds trade opposite to yields and interest rates. And when interest rates went to zero in 2020, these funds as a whole went up to new highs, and with rates at zero, they reached the highest value ever. They made a secular peak, and now they've spent the last year and a half rolling over and are now in bear markets. What this means is that bond funds are in bear markets now. It's a secular cycle, and that safety 40 to 60% portion of people's portfolios that they have are now millstones on their accounts. That's my opinion. I'm not an investment advisor, but if I had an investment advisor, I would want to get their opinion about, what to do in a rising rate environment when rates were set at zero and inflation is at annualized 7%. These funds are complete disasters. It's not just LQD, it's all of them, the J&K ETF, the TLT ETF. But there's funds that specialize in bonds that people own even more than that. And this is a serious problem for the stock market going forward. And you have to turn the page back to the 1970s to find a similar macro environment we're in now, in which you have inflation and bond values going down. The difference is we're coming from zero interest rates. So, interest rates haven't even gone up yet. So it's absolutely an amazing environment. But if we turn back to the Nasdaq, because frankly, that's what 99% of all investors and traders are obsessed with, is tech stocks and Nasdaq. Well, I want to point out a couple of things in this chart. This is a chart of the Nasdaq going back to 1990, and I think we're making a top as seen like in 2007 or 2000, and I would actually say that the rally we saw from the low 2020 till December in the Nasdaq is very similar took place in 1999. A straight up move in which the price gains accelerate from the years before, and it leads to a huge top. So if we look at the bottom of this, the two indicators below the price here, the first one is a rate of change, a simple rate of change of over 200 days. And you can see how this indicator spiked above 75. And that was because we had this tremendous rally from the March 2020 low up until last year. And that caused this indicator to jump up to a move not seen, since 2009. And then you got to go back to 2000. So it was a historic volatile move in this indicator, and it caused the Bollinger Band width indicator, which is the 200-day average of volatility, to jump up to 60. Now it's at 20. And one thing you should learn or take away from this, if you disagree with everything I said before in this video about inflation and being in a bear market, okay, there are people that vehemently have an opposite viewpoint, and I'll say that Kathy Wood is the biggest person on YouTube, and people follow her, and she's got such a big following that there are people making YouTube videos mimicking her language and words and phrases that have big followings. And I'm like one little guy out here that has the opposite view, and that's why my YouTube videos do not get many views, because most people believe the things she says. Most people are extremely bullish on these technology stocks that they still own. But everyone, including Kathy Wood, including me, will agree on this fact. So keep this in mind as we get to my top trade now, an investment. The fact is, Nasdaq stocks and ARK stocks, and these stocks are extremely volatile. So these people that are still bullish, they'll tell you these stocks are volatile. They'll just say, ignore the volatility because it'll go up eventually and you just got to live through it. Well, why not get into something that's not as volatile as these technology stocks that still has the upside potential? That's why I like what I'll present with you as my top trade in a few moments. I like things where risk is diminished and you got the upside still there. No matter what you believe about the direction of the markets, that is the key to long-term trading and investment success. So again, this is my view of the NASDAQ. And let me show you something very bullish that just made a new high. This is the Commodities Research Bureau Index. So rising commodity prices create inflation. Simple as that. The grocery store prices go up when agriculture prices go up, food, farm prices go up, the price of cows, corn, wheat, coffee, they rise. Well, that trickles over into the grocery store and CPI data, and oil goes up in value. Well, guess what? The prices at the gas tank go up too. Well, the CRB index just made a new high last week. So how in the world is the CPI going to go straight back down as these people are claiming when this just made a new high just Friday? It won't. This is saying inflation is still going up. And the reason I think, one of the reasons I think inflation is going to go up for years from here, this isn't just a short-term trend, is because of this chart here. What happened in 2020 is that we had a bear market in the price of commodities really since 2008. In 2014, there was an acceleration of the bear market because oil had a top that year. And then in 2020, commodities fell. I think they made a secular bottom. And a secular trend is a trend that lasts for years, not just a few days, not just a month, not just 1 year, but multiple years, a decade. So we are in a decade. We ended a bear market that started 12 years ago in commodities in 2020. So that means, we're in a bull market. It's going to last for years. And the thing to do in bull markets that last for years, like we had in the stock market, I believe, since 2009 till recently, is buy on dips. Buy when you hit the 200-day, 153 moving averages, because you're in a stage 1 bull market in which those moving averages then act as support. If these are new concepts that you've never heard before, grab my book, Strategic Stock Trading. Just type that in on Amazon. So, commodities bullish. If you want to make money, buy into sectors and stocks related to the uptrend, the bull market in commodities. Energy stocks are going up this year, while ARK, while Nasdaq, while Facebook are in decline. So that's a place to make money. And a lot of energy stocks pay nice dividends. So I could go on and on about buy this, buy that. And we got to limit this video, and we got to get to the number 1 trade I see right now. And it's gold. So gold has been consolidating now since for over a year and a half. The 200-day Bollinger Bands are have basically gotten extremely narrow, and they measure volatility. And when the bands get narrow, it happens towards the end of a consolidation. Then the bands will start to expand as the next giant run or sustainable move that lasts for months, years begins. And the Bollinger Band width indicator is on the bottom. We're looking at the long-term 200-day width indicator, and as you can see, it's at 8.584, the lowest reading since 2005. In 2005, gold went through 450 or so, and then went up to 1900 6 years later. So you're talking about basically almost let's just say a 4.5 times move, 4.5 multiplier on your money over 6 years took place then. Of course, the multiplier is even bigger if you got in at 300. So I think we're looking at a similar multiplier over the next 5 or 6 years from here in the price of gold, just like what happened from 2005 to 2011. The thing is, that's incredible from an investment standpoint. And it serves as an alternative to just parking all your money in bond funds. There are funds that track gold that I own. IAU is one. It's an ETF. The Central Fund of Canada, CEF, also owns silver, something I own. GLD is another one. But another thing I like about gold is that it's less volatile than the Nasdaq, less volatile than the stock market. And you can see that in the rate of change indicator below. It's changed, made a 4% move in the past 200 days. Whereas the Nasdaq can swing up or down 20%. So this is now, ironically, gold is trading less volatile than bonds. It's not swinging up and down. The price isn't changing as quickly as we're seeing in the stock market or the bond market. It's a sleeping giant, I believe, because it's still consolidating, and it's got to go through 1880, 1900 before people get really bullish and start to see it breaking out, realize, oh, this is running now, I got to get in the rally. Most people love to chase. They don't like to buy things, going sideways. But I think from an entry point, it's incredible because it's around 1850, and you could put a stop loss order in, 10% away. I just don't think it would ever get hit. You're 5% away even, or put it at 1775, or the risk is very, very low, and the upside is tremendous over the next 5 or 6 years. And in 1 year, it can go up 30%, and the mining stocks will go up even more. But I just want to focus on gold itself as the best trade I see right now from a risk to reward standpoint, because it's still not that far away from its lows of, let's say, December, and it's very close to breaking out. It could break out this week. I can't predict when it's going to break out, but I think that moment is drawing near. And this is the IAU ETF, very close to going through the equivalent of 1900 on gold, is really right below 36, and this is at 35.41. So it's very, very close. And you can see I own this. If you bought it, you could put a stop loss order at $33, and the odds of that ever getting hit, I believe are like very, very low. You're not even risking 10% with a stop loss order there, and you've got something that can go up 4 times from its current price over the next couple years. Why not have a core position in that, is my thinking. And so I do in my retirement account. and my main trading account, and so forth. So this is my number one trade right now in the markets. Let's see what the Fed does tomorrow, because frankly, I'll just tell you, I own gold, I own mining stocks, but I'm actually thinking of increasing my position. If the Fed does, I want to see what the Fed does tomorrow and short term, and how the markets react. And I may increase my position here, in fact. So that's actually what I'm looking at Monday myself, possibly increasing my position in the metals markets. So all that said, going to be very fascinating Monday and rest of the week in these markets of everything that's been happening. And this is the first time you see me on YouTube, please hit the like button. That will tell YouTube that people do like these videos, even if they're not the style and content type or same alignment with Kathy Wood. And also hit the subscribe button and then hit the bell next to it. And then YouTube will send you a notification as soon as the next video I do is up. And so let's see what happens in the markets this week.